Welcome back to the Deep Dive. Today we are tackling, just one of the most storied and complex corporate sagas of our time. We're talking about the Great Unwinding of General Electric.
Yeah, for decades, GE was, the definition of a conglomerate. They made everything from light bulbs to jet engines.
And ran a massive bank on the side.
Exactly. And that complexity, well, it really became a huge liability. So our mission today is to look past the old GE, the history, and really focus on what's left. The new, standalone GE Aerospace.
Yeah, and this isn't just a breakup story. It's about the birth of a new, incredibly focused company.
That's right.
We're digging into this using a really comprehensive investment analysis report. It goes deep into their strategy, their performance, all the way through 2025, and of course, the competitive landscape.
And the context here is just immense. After a really painful decade of restructuring, GE has finally completed what they're calling the Great Unwinding.
So what was the ultimate goal of all that pain?
Well, the goal was simple to say, but just incredibly hard to do. Get rid of the conglomerate discount.
Okay, what is that exactly?
It's basically the penalty the market gives a company for being too complex, too opaque. Investors couldn't figure out where the money was going, so the plan was to unlock all that trapped value by creating three separate, focused, investment-grade companies.
And we really need to understand the timeline, because this change was absolute. We're talking about shedding huge, iconic parts of the business.
It was incredibly swift at the end. First, you had GE Healthcare, the medical device giant that was spun off back in January 2023.
Right.
Then came the energy portfolio, GE Vernova, which just spun off in April 2024, and that leaves what's left, the original company, which keeps the GE ticker.
Is now just GE Aerospace, solely focused on jet engines.
That's it, designing, building, and servicing engines for commercial and military planes.
So we've gone from this sprawling giant that, frankly, no one could understand, to a pure-play aerospace leader. The question we're really diving into is whether this new company is truly set up for an industry supercycle, and if its financial model, this thing analysts are calling the cash flywheel, is as solid as they claim.
Let's get into it.
Okay, let's unpack this transformation. This was more than just moving numbers around on a balance sheet. This was like complex corporate surgery. So what was the core reason for dismantling a company that had been built on diversification for, what, a century?
It really all came down to that complexity. In the old GE, the balance sheet was it was a black box. Investors had no idea where the capital was actually going.
Right. Was it propping up the power division, or was it going to the growing aviation business?
Exactly. You had all these different business cycles fighting for cash. The separation allows GE Aerospace to just focus on aerospace. They can put their money where the highest returns are with, surgical precision.
And a huge part of this wasn't just splitting up the company, but fixing the balance sheet. The old GE was just drowning in debt.
It was an existential crisis, really,
Yeah.
and the debt repair they undertook was, frankly, monumental. The credit for this whole turnaround goes pretty much to one person, Chairman and CEO Larry Culp.
The first outsider CEO in their history.
Right, and the number is just staggering. Since he took over in 2018, GE has retired over $100 billion in gross debt.
$100 billion. That number is just... It's hard to even comprehend. How did they even do that?
It was just ruthless prioritization. Selling off huge established divisions like the biopharma unit to Danaher, which was Culp's old company.
Oh, okay.
Selling off big stakes in oil and gas, getting rid of financial assets. That deleveraging was the foundation for everything because it allowed GE Aerospace to launch with a solid investment-grade credit rating. It got rid of the financial anchor that had been holding them down for years.
So with the money side sorted out, let's talk operations. You can't run a company like this without a clear philosophy. The report highlights their lean system, the flight deck model.
Flight deck is really the heart of the new culture. It's their own lean operating system, and it's all about continuous improvement.
And during the unwinding, it was basically what kept the trains running on time.
It prevented total chaos. It's all about decentralizing decisions, pushing authority down to the factory floor, and focusing on four key things: safety, quality, delivery, and cost. SQDC.
Okay, but SQDC sounds a bit like corporate jargon. What does that mean in practice? Like on a Tuesday morning at a factory.
Okay, so imagine you're on a factory floor. There's a physical flight deck board, and those metrics, SQDC, are updated constantly. If quality dips or a delivery is late, the team leader has to flag it immediately and come up with a fix, like within the hour.
So it's not waiting for an email from corporate.
Not at all. It empowers the local manager to solve the problem right then and there. And that kind of discipline was absolutely essential when they were trying to untangle, decades of shared IT systems and sort out massive pension liabilities, all while keeping thousands of jet engines flying safely.
So while the corporate headquarters was being torn apart, the factory floor was more disciplined than ever.
Precisely. And that's why management credibility is maybe the most important intangible asset they have now. Culp's execution, navigating all that complexity, paying down the debt, successfully launching 3 separate companies, it has totally rebuilt investor trust.
After years of nasty surprises from the old GE.
Exactly. That track record for transparency is priceless.
So now that we have the foundation, let's look at what the new GE Aerospace actually does. It's broken down into 2 main segments, and we have to start with the big one. Commercial Engines and Services, or CES.
Yeah, CES is the economic powerhouse. It's the engine, no pun intended, that drives the whole company. It generates most of the profit and, more importantly, the highest quality free cash flow.
And we're talking about the biggest engines in the world here, the flagships.
Oh, absolutely. For the big twin-aisle jets, you have the GNX engine, which powers the Boeing 787 Dreamliner. Then there's the legendary GE90, the workhorse on the massive Boeing 777 fleet.
And looking forward.
Looking forward, they have the GE9X, which is the exclusive engine for the upcoming Boeing 777X. These things are engineering marvels.
But the real volume, the day-to-day workhorse of global aviation, is the narrow-body market. And that's handled through a partnership, right?
That's the pivotal CFM International joint venture. It's a 50-50 partnership with Safran Aircraft Engines from France. And this JV absolutely dominates the single-aisle market. We're talking about your 737s and A320s.
Which is the biggest and most profitable part of commercial aviation.
By far. It's responsible for the vast majority of flights around the world.
And what are the key products that make CFM so dominant?
Well, there are 2 huge engine families. The older one is the CFM56, which is still everywhere. There's an installed base of over 24,000 of them still flying.
Incredible.
And then there's the next generation LEAP engine, which is the current industry leader. That joint venture is just a colossal source of predictable long-term cash flow.
Okay, that covers the commercial side. The second segment, Defense and Propulsion Technologies, or DPT, is smaller but plays a really specific strategic role.
Yeah, DPT is the military side of the house. They provide engines for the U.S. Department of Defense and its allies.
So what are we talking about here? Fighter jets?
Yep, frontline fighters. The F-110 engine powers F-16s and the new F-15EXs. The F-404 and F-414 series are on the FA-18 Super Hornet. Plus, they dominate the helicopter market with the T-700 and the new T-901 engines on the Blackhawk and Apache.
So what's the strategic value here? Is it just some extra revenue on top of the huge commercial business?
No, it's much more important than that. It's a critical counter-cyclical hedge.
Training.
Meaning commercial air travel is notoriously cyclical. A global shock hits, think 9/11, the financial crisis, a pandemic, and travel just starts after market revenue dries up.
Right, but defense spending keeps going.
Or even increases, depending on the geopolitical situation. So DPT provides this incredible stability. It insulates the company from those commercial shocks, and right now it's benefiting from this global upswing in defense spending. It balances the whole portfolio.
So this brings us to the core of the investment case. The report describes GE Aerospace as having maybe the widest moat in the entire industrial sector. So why is their business model considered so superior? Let's start with that classic razor and blade model.
This is absolutely crucial to understanding how they make money. The idea is you use the initial sale, the engine itself, the razor, as a strategic move to get onto the wing of the plane.
And you sell that razor cheap.
Very cheap. Sometimes even at a loss. They do that just to secure that spot.
So where does the actual profit come from?
It comes from the blades, the high margin, recurring aftermarket services, the spare parts and mandatory shop visits. You have to service that engine with their proprietary parts, with their certified labor, for its entire 20 or 30-year life.
And they have a massive installed base to sell those blades to.
Over 44,000 commercial engines globally. Once an airline chooses that engine, they are locked in for decades.
And that model creates an incredibly high-quality revenue mix.
It's the gold standard. About 70% of GE Aerospace's total revenue comes from services.
70%, that's huge.
It is, and that revenue is recurring, it's less volatile, and critically, it's usually inflation protected through long-term contracts. This is the very essence of the cash flywheel.
So let's look at their competitive position, starting with the narrow-body market, which is the biggest piece of the pie. Through CFM, they seem to have achieved almost total dominance.
Yeah, The narrow-body segment is the economic engine of aviation, and the CFM LEP engine powers 100% of the Boeing 737 MAX family, a total monopoly on that airframe.
100%. And what about on the Airbus side?
On the Airbus A320neo, they compete with Pratt & Whitney, but the LEP still has about 60% of the global backlog. That level of market penetration is just a massive structural advantage.
And that dominance is even stronger because of the major problems their main rival, Pratt & Whitney, has had with its geared turbofan engine.
Oh, this isn't just a small technical issue. This is a multi-billion-dollar gift to GE. The GTF was technologically ambitious, but it has been plagued with durability problems.
Most famously, the recall over powdered metal defects.
Exactly. A rare manufacturing flaw in critical engine parts.
So what did that actually mean for the airlines? Planes on the ground.
Hundreds of planes on the ground. It meant mandatory inspections, premature, very expensive shop visits. It just shattered Pratt & Whitney's reputation for reliability. So now you have airlines, especially in tough environments like the Middle East or India, who are just shifting their orders to the AA.
Because they prioritize reliability over everything.
Over everything. So it's this huge unearned advantage for GE Aerospace.
Okay, moving to the wide-body market, the big jets. The story of GE's leadership is even more pronounced there.
Yeah, in twin-aisle jets, GE is the undisputed leader. They power most of the world's Boeing 777s with the G90. They power a huge chunk of the 787s with the GEnx. But the real crown jewel
Is the GE9X.
the GE9X. They got the ultimate prize, a sole source contract. It is the exclusive engine for the upcoming Boeing 777X.
And that guarantees them decades of revenue.
Decades of original equipment sales, and, much more importantly, a guaranteed, incredibly lucrative aftermarket stream.
So where does that leave the other big player, Rolls-Royce?
Rolls-Royce is a fantastic engineering company, no doubt, and they dominate on the Airbus wide-body planes, the A350, the A330neo. Their Trent engines are world-class. But, and this is the key, Rolls-Royce has zero presence in the narrow-body market. None.
So that limits their total addressable market.
Massively. It means they can't compete in the biggest, most stable part of the market, which gives GE a huge structural advantage across the board.
When we talk about moats, this industry really is the definition of an oligopoly. So why can't a new competitor just, show up with a bunch of money and start building engines?
Well, the barriers to entry are just ridiculously high. First, you have the regulatory barriers. Getting safety certifications from the FAA and EASA for a new engine. It takes years and billions of dollars.
So that freezes the industry with the players that are already there.
Pretty much. And then there's just the sheer amount of money you need to even get started.
The capital barrier.
It's unbelievable. Developing a new engine platform costs somewhere between $15 and $20 billion over its life before you see any real return. Even today, GE spends about $3 billion a year just on R&D to stay ahead.
So let's talk about the specific things that lock customers in, the components of the moat.
Okay, number one is switching costs. Once an airframe, like the 7M and 7X, has an engine, you can't just swap it out. The wings, the systems, the weight, it's all designed and certified around that one engine.
So re-engineering it would cost billions.
The airline is locked in for the entire life of the plane, 30 years.
And the second part is their technology. Specifically, these advanced materials the report mentions, ceramic matrix composites or CMCs, what are those?
This is really their secret sauce, the engineering moat. So traditional engine parts are made from metal superalloys. CMCs are these incredibly lightweight materials made from woven ceramic fibers.
And the big advantage is they can handle way more heat than metal.
Hundreds of degrees hotter.
Why does running hotter matter so much for an engine?
The hotter an engine runs, the more efficiently it burns fuel. And that translates directly into huge fuel savings for the airline. GE was one of the first to get CMCs into the hottest part of the engine, which gives their engines, like the GE9X, industry-leading fuel efficiency.
And fuel is the single biggest cost for any airline.
Exactly. So that technological IP is a massive advantage that is very, very difficult for anyone to copy.
All right, let's get to the numbers, which really seem to confirm that this whole pure play strategy is working. Let's look at the recent performance through 2024 and 2025.
Yeah, the performance has been a huge validation of the whole idea. In 2024, they reported adjusted revenue of $35.1 billion. That's a solid 10% year-over-year growth.
But the forward-looking numbers are even better.
That's right. Total orders surged 32% to over $50 billion. That massive order book gives them incredible revenue visibility for years to come.
And what's driving that growth? Is it just selling more new engines?
It's a mix. They are delivering more new engines as the supply chain gets a little better. But the real driver of profitability is pricing power in the aftermarket.
The services.
Spare parts revenue was growing in the mid 20% range. They can raise prices because they're the only source for those certified parts. It's a direct benefit of that wide moat.
And this is where the story gets really compelling. The margin expansion. Profitability is just surging way faster than revenue growth.
We are seeing massive operational leverage. Operating profit jumped 30% to $7.3 billion in 2024. And that means the overall operating margin expanded by a remarkable 330 basis points to almost 21%.
Okay, hold on. For those of us who aren't in finance, what does 330 basis points actually mean in plain English?
Right. A basis point is just 1/100th of a percent. So 330 basis points is a 3.3% jump in their profit margin.
And for a company this size, that's billions in new profit.
It's huge. It's a massive signal that their costs are under control and that the mix of their business is shifting towards the really profitable stuff.
And that's the services mix effect.
Almost entirely. Because the high-margin aftermarket work, the shop visits, the parts sales, is growing faster than the low-margin new engine sales, the profitability of the whole company just lifts off.
We can see this most clearly when we look at the profitability of the commercial engine segment.
It's pretty stark. In the third quarter of 2025, the CES operating profit margin hit an almost unbelievable 27.4%.
27%. That's a margin you'd expect from a software company, not a heavy industrial manufacturer.
It's a premium margin for a premium product with basically a monopoly on its aftermarket.
Now, the defense segment margins are much lower, around 13.6%. Is that a weakness?
Not at all. It's just a different business model. Defense contracts have lower margins, but the volumes are incredibly stable. Its job is to be the anchor, not the high flyer. And that 13.6% is still a really healthy, expanding margin for a defense business.
Okay, if margin is the story of efficiency, then free cash flow, FCF, is the real linchpin here. Why does that matter so much?
FCF is the lifeblood. It's the actual cash left over after you've paid all your bills and invested in your equipment. It's what you use to pay dividends and buy back stock. In 2024, they generated $6.1 billion in FCF, up 28%.
But the really critical detail is the FCF conversion rate.
This is the golden metric. They achieved an FCF conversion rate of greater than 100% of their adjusted net income.
So that's the proof that the profits are real cash, not just accounting magic.
That is exactly what it is. It's the gold standard, especially for an industrial company that has to manage huge amounts of inventory. It means their profits are clean, backed by actual cash. It signals incredible operational discipline, which is a direct result of that Flight Deck system.
So with all this reliable cash pouring in, how are they using it? The big debt paydown is mostly over.
The strategy has shifted completely to shareholder returns. Their stated goal is to return 70 to 75% of their available funds directly to shareholders.
That's a huge number for a company that just went through this kind of restructuring.
It is, and they're being very aggressive about it. They authorized a $15 billion share buyback program.
Now they're actually executing it.
They plan to do $7 billion worth in 2025 alone. Reducing the share count is just a guaranteed way to boost earnings per share.
And they also raised the dividend.
By a substantial 30%, it's another strong signal of their confidence in the durability of that cash flow.
And finally, circling back to the balance sheet, it really is a new company.
The transformation is complete. Long-term debt is way down, and they've de-risked their massive pension obligations. That old pension deficit was a constant cloud of risk over the old GE. That cloud is gone.
All right, so let's look forward. The house is in order, the debt is paid. Where does the next big wave of cash come from?
The primary growth driver for the next decade is the aftermarket ramp for the current fleet of engines. And this is where it gets really interesting.
This is the flywheel spinning up.
Exactly. The huge fleet of LEAF engines that they've delivered over the last several years is just now starting to enter its first major maintenance cycle, its first big shop visit.
And that first shop visit is a massive revenue event for every single engine.
A multi-million-dollar, almost pure margin event. Since the LEAF fleet has grown so quickly, they're now looking at a multi-decade wave of scheduled, mandatory, high-margin revenue.
What's the forecast for that?
Management is forecasting services revenue to grow at a low double-digit rate every year through 2028. That's incredible visibility.
And there's this fascinating paradox where the current supply chain chaos in the industry is actually helping them.
Right. This is the crucial CFM56 bridge. Because Boeing and Airbus are having trouble delivering new planes, airlines can't retire their older ones. They have to keep flying their older fleets, which includes the huge fleet of legacy CFM56
So
engines.
delays on new planes mean the old engines keep flying and they need more maintenance.
Precisely. It's this unexpected surge of high-margin cash flow from the old engines that provides a perfect bridge until the LP aftermarket really hits its peak later in the decade. The chaos actually helps them.
Now, the defense segment provides stability, but it also seems poised to capitalize on this defense suture cycle we're seeing.
Absolutely. Geopolitical instability is driving defense spending way up. And the legacy F-110 engine, which powers a lot of international F-16s and F-15s, has seen a major resurgence.
I saw they secured a very large contract in 2025.
A $5 billion contract for foreign military sales. It's basically a long-term supply agreement for allies like Saudi Arabia, Bulgaria, and Jordan. It locks in a very predictable revenue stream for years.
And beyond today's engines, GE is at the forefront of the next generation of military tech.
They are a core partner in the Next Generation Air Dominance Program, or NGAD. Their XA-100 adaptive cycle engine is central to the future of the U.S. Air Force.
So what is an adaptive cycle engine?
Think of it like a transmission with multiple gears. It can physically change how air flows through the engine, so it can run like a fuel-efficient turbofan when it's cruising.
And then instantly switch to a high-thrust turbojet for combat.
Exactly. They secured a $3.5 billion contract modification in 2025 just to mature this technology. It basically ensures they will power the next generation of fighter jets.
And we can't forget helicopters.
The T901 engine selection for the Army's Black Hawk and Apache fleets is another huge win. It's another stable, long-duration stream of military services revenue.
So maintaining this wide moat requires constant innovation. We know they spend about $3 billion a year on R&D, but the big push now is for sustainability. Let's talk about their big future program, RISE.
Yeah, the RISE program, run through CFM, is their answer to climate pressure. It's how they plan to dominate the next big replacement cycle for narrow-body planes.
And the core technology here is this open fan architecture.
It's a radical design. Instead of the fan blades being inside a metal case like on a normal engine, the fan is exposed.
So it's just out in the open.
Right. And this allows for a huge increase in the amount of air that flows around the engine core.
Which translates into what kind of benefit?
Massive efficiency gains. The open fan is projected to cut fuel use and CO2 emissions by more than 20% compared to today's best engines.
And this isn't just a science project. This is a strategic play for the 2030s.
That's it. The 737 MX and A320neo fleets will eventually need to be replaced. RISE technology positions GE to be the undisputed leader when that happens. They're investing now to secure the next 40 years of commercial flight.
And they're also looking at even more revolutionary ideas, like hybrid electric.
Yeah, they're working with NASA and Boeing on that. It's a longer-term play, but it just shows they're actively mapping out the future, not just making small improvements.
Okay, this all sounds like a flawless story, but no business is without risk. Let's talk about the major headwinds, starting with the supply chain.
Yeah, the supply chain has been the constant headache for the entire aerospace industry. Through 2023 and 2024, GE struggled with severe shortages of specialized raw materials like titanium and nickel, and critical parts like castings, and of course, a shortage of skilled labor.
So how did their new flight deck system respond to that crisis?
This is where it really proved its worth. They launched what they called the FlightNate Deck Response. It was a super aggressive intervention. They sent hundreds of their own engineers and supply chain experts directly into their suppliers' factories.
So they literally sent their own people in to help run the suppliers' production lines.
Effectively, yes. They were there to help fix bottlenecks, optimize schedules, transfer best practices. It was a massive commitment of their own people.
And did it work?
By the third quarter of 2025, it was paying off. Material input from their most critical suppliers was up over 35%. That was the turning point that let them finally start to ramp up production.
Now let's talk about the LEP engine itself. We talked about its success, but you hinted at a durability challenge.
Right. So to get that high fuel efficiency, the LEP engine has to run hotter than the old CFM56.
And running hotter means more wear and tear.
It accelerates wear, especially in harsh, hot, and dusty environments. Think India, the Middle East. This led to disappointing time on wing, how long an engine can fly before it needs maintenance.
Wait, so the new, better engine was actually wearing out faster in some of the world's biggest growth markets. That must have caused some serious problems with airlines.
It was a huge concern. It led to a lot of difficult conversations with major customers. The frequent unscheduled shop visits were expensive and disruptive.
So what was the fix?
They had to roll out these comprehensive durability kits. These are redesigned turbine blades and other system modifications. The goal is absolutely critical for their reputation.
It is what?
To double the time on wing and bring the LAP's reliability up to the same legendary standard as the CFM56. If they can do that, they lock in the market for a long, long time.
Okay, another major risk is customer concentration. They are tied at the hip to Boeing and Airbus.
That's right. Their fate is linked to the production rates of those two companies, especially Boeing. The biggest specific risk right now is the constant multi-year delay of the Boeing 777X.
Which is now projected for 2026, maybe?
Maybe. And every delay has a direct financial consequence for GE.
Because they're the exclusive engine supplier.
Exactly. Every delay pushes back the revenue for hundreds of new GE9X engines and, more importantly, pushes back the start of that incredibly lucrative aftermarket cycle. That's a huge amount of high-margin revenue just sitting in a queue.
And beyond production, you have geopolitics. China is a huge market, but also a huge risk.
It's a massive risk. Political tensions could easily lead to trade restrictions that hurt their sales and service business there, and they're still vulnerable to supply chain disruptions for critical materials, like titanium, which historically came from Russia. They've had to work hard to diversify away from that.
Okay, this brings us to the elephant in the room, valuation. The stock trades at a really hefty premium. What do the multiples look like?
The valuation is definitely premium. Based on late 2025 estimates, GE Aerospace is trading at somewhere around 37 to 40 times forward earnings.
40 times earnings. That's the multiple you'd expect for a high-growth tech company, not an industrial manufacturer.
Right, and it's a huge premium over its main rival, RTX, which owns Pratt & Whitney. That gap reflects GE's clean balance sheet and the massive operational problems at Pratt. GE is being valued like a pure-play monopoly.
So you have a clear bull case that says this premium is deserved.
The bull case is that they deserve a monopoly-like premium because of that unparalleled installed base. You have visibility into decades of inflation-protected cash flow. If they hit their target of $10 billion in operating profit by 2028, you can argue that the multiple is justified. The quality of the earnings is just that high.
But with a 40x multiple, the bear case must be pretty simple. You're paying for zero risk.
Exactly. The bear case is that the stock is priced for perfection. There is absolutely no room for error. Any stumble, if the LEP durability kits don't work, if Boeing delays the 777X again, could trigger a major repricing of the stock.
And what would that look like?
It could be a swift and painful drop. Some discounted cash flow models suggest the stock could be overvalued by 30 or even 50% at its current price. The risk isn't about the quality of the business, it's about the price you're paying for it.
But ultimately, it all seems to come back to the quality of that cash flow.
Despite the high price, the quality of the asset is undeniable. It's structurally superior, has incredible pricing power, and it's all supported by that greater than 100% free cash flow conversion. The price is high, but the certainty of the future cash is extremely rare.
So to synthesize everything we've talked about today,
Yeah.
GE Aerospace is a totally different company from the old GE. It's hyper-focused, it's benefiting from these two massive tailwinds, the commercial supercycle and the defense upswing.
And the business model is just structurally better, anchored by that high-margin recurring services revenue from a massive installed base. It's a case study in clarity and operational rigor.
So as we look forward, what are the three critical things that you, the listener, should be watching to see if they can sustain this success?
Okay, number one, watch the success of that LEB durability kit rollout. They have to get that time on wing performance right. Second, look for continued improvement in the supply chain. They have to keep the parts flowing to meet their orders.
And number three.
And number three, the big one, the entry into service of the Boeing 777X. That event finally unlocks the next huge aftermarket cycle for the GE9X engine.
Now, if we connect this all back to the Great Unwinding, there was one significant non-core liability that GE Aerospace kept from the breakup. What was it, and what does it mean for the company?
Yeah, this is the one ghost of the past that's still sort of hanging around. They retain the massive runoff insurance portfolio, specifically long-term care insurance.
Which is a notoriously difficult business.
It's an opaque, long-tail financial risk. Now, the question isn't whether GE Aerospace can fund this liability. Their cash flow is so strong they clearly can. The question is whether this non-core financial risk could ever become a material drag on the core aerospace business over the next decade.
It's a fascinating reminder that even in the cleanest corporate split, some remnants of a complex past can still linger. It certainly makes you wonder what other big conglomerates might benefit from following Culp's Great Unwinding blueprint.
And that, of course, is a deep dive for another day.
For now, that was the deep dive on GE Aerospace.